The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Merger Monday lives up to its name, but the question is, will it live up to the hype? Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Katie Greifeld. We're kicking you off to the closing bell here in the U.S.
Congratulations on your New York marathon finish time.
I didn't quite run it, but anyway, let's get to these markets right now. It is the first trading day of November. We're coming off of 6 straight monthly gains on the S&P 500, continuing the action today. The S&P 500 up about 0.2%. Big tech leading a lot of that. The Nasdaq 100 higher by about 0.5%. Romaine will tell you why in just a moment. But I wanted to take a look at the bond market as well. The story over the past couple of weeks, months has been buying. Not today. You can see the 10-year yield after hitting below 4%. We've been back above it. Now looking at 4.10 on your benchmark 10-year Treasury rate. And then you take a look at the small caps, the Russell 2000, the underperformer today, and then some down about 0.5%, Romaine, as those yields rise.
Yeah, absolutely. When you look at what's going on in the equity market, if you're not in big tech or you're not in the M&A business, you're not going anywhere. In fact, M&A, it's back in a big way on this Monday with companies announcing $224 billion of mergers and acquisitions in the U.S. last month, highest volume since June of 2019. In November, already looking like it could be just as strong. A flurry of announcements today alone, $80 billion in deals flagged. That includes, of course, Kimberly-Clark's $40 billion play for Kenvue and Eaton Corp's $10 billion bid for Boyd Thermal. That is an AI play. And of course, we have seen a lot of activity in that space. Those deals continue to roll in as well, with Amazon Web Services agreeing to supply OpenAI with $38 billion in computing power, Microsoft agreeing to buy $9.7 billion in AI cloud capacity from IREN. The ripple effect going beyond equities and into the fixed income space, with Alphabet receiving orders of about $90 billion for its $15 billion jumbo bond sale, a splash of cash that Microsoft President Brad Smith says is just beginning.
Demand is clear. It is present. Our biggest challenge is not a risk of getting ahead of demand. It's actually keeping pace with demand.
But as AI dominates the capital markets, the rest of the economy is on tenterhooks. Corrugated box shipments, a proxy for retail sales, just posted the lowest third quarter reading since 2015. U.S. factory activity, particularly at textile, apparel, and furniture plants, that's contracted for an 8th straight month, and a concerning divergence right now in consumer credit, with the share of consumers now in the subprime credit category reaching levels, Katie, not seen since 2019.
Well, let's go from corrugated box shipments over to the labor market, because in a parallel universe, we would get NFP data on Friday. That parallel universe where the U.S. government is open, not the one that we're living in. So I thought it would be interesting to take a look at NFP's monthly change, the 3-month average versus ADP's 3-month average change, because usually the line between the monthly figures is a little bit fuzzy, but when you look at it in this sense, take a look at the 3-month averages, it starts to correlate a little bit more. Now, when it comes to NFP, we only have the 3-month average as of the end of August, so do with that what you will, but you can see that the line has been trending downwards, and it looks like the inflection point, Romaine, was earlier this year, maybe around April, March, that sort of time, maybe even earlier than that. So the trend is there, that this labor market is downshifting, it is cooling, and even though we don't have the official textbook data from the U.S. government, that seems to be the message, and all the various pieces that we're pulling from corporate America as well.
As we kick you off to the close, let's bring Rebecca Patterson into the conversation to help us out. Senior fellow at the Council on Foreign Relations and former chief investment strategist at Bridgewater Associates. And Rebecca, it's kind of become almost a joke here. If you lined up 10 economists and asked them how the economy is doing, you probably would get 10 different responses. And I'm not really sure what to make of it. I look at that chart Katie shows, which seems to suggest softness in the labor market. But then you talk about certain sectors right now in the economy where it seems like they can't even get their hands on enough workers to see things through.
Hey, Romaine, it's great to be with you guys today. And I agree. We have a number of divergences, both in the economy and the financial markets today, which makes it hard to have a lot of confidence in anything. I mean, you mentioned the labor market. cooling, but even within that, you hear different stories. Not enough workers in certain sectors like construction. Meanwhile, layoffs in other sectors, often white-collar jobs tied to AI or just business uncertainty and keeping costs down at large companies. The consumer, we've already seen the difference between the higher-end and lower-end consumer, the latter really struggling, and the economy really dependent on that higher-end consumer continuing to spend. We see it in the equity market, both large cap versus small and tech versus basically everything else, maybe with a little bit of financial thrown in there. And then lastly, monetary policy. Do they focus on labor? Katie just mentioned the softening labor market, or inflation, which is still sticky and 1% above target. So there is a lot of disconnects here. I almost think of it like a Jenga game. It keeps getting taller. GDP is going up. Equities are going up, but it's getting wobblier. And that means that there's more risk that as investors we need to think about.
What are you paying attention to? I mean, we talk a lot about the government shutdown now potentially headed for what is going to be the longest ever, already the longest ever with regards to being a full government shutdown. But we don't have the data. We have other data out there. Katie makes fun of me for my corrugated box shipments, but as a son of a box maker, I have to tell you, it does say a lot about where people are spending and where the economy is going. What do you look at, Rebecca?
I mean, 100%. I think all of us should be creating our own mosaics of the economy, whether that's looking at corrugated boxes or it's reading that Fed beige book that comes out ahead every meeting. That gives you a lot of real-time snapshot pulse of the economy. So there's plenty of data, even if the government data is the gold standard, but there is enough data that we can get a decent picture of the economy right now, even with the shutdown. I worry about the shutdown lasting much longer. I mean, my guess is that when we see more disruption to airlines and people need to get home for Thanksgiving holidays, that could light a fire under both parties in Congress. That's not going to play with either party if people can't get to their loved ones at Thanksgiving. But either way, we're talking about probably a point or so off GDP every month. Some of that will come back when the government reopens, but not all of it. And now we're talking about things like social assistance programs like SNAP being removed. That's going to pull that lower end consumer more. So these are things I'm definitely keeping a close eye on. And on inflation, we are seeing rent inflation moderating. We are seeing gasoline prices moderating. We're seeing wages moderating somewhat. However, we all know the core goods prices are going up. So it's not clear to me if inflation is going to give the Fed as much room to cut as the market's discounting, which right now is about a 65% chance that we get a December cut.
Right, that's the thing. I mean, we heard from Fed Chairman Jerome Powell last week saying basically that when it comes to a December rate cut, it's certainly far from being a lock. And I wonder how that translates into the equity market, because, okay, 65% chance here being priced in, that's still decently higher than 50. And you think about where we stand when it comes to the S&P 500, we've certainly come very far, very fast, and the breadth has really been concentrated in the tech sector. If we don't get that rate cut come next month, if you do see inflation kind of sort of boxing the Fed in here, I wonder what that means for this equity market.
I mean, it certainly is going to slow the rally down at a minimum. But I think there's, when you have the equity market so dependent on one sector, and within that sector, a small handful of companies, really, the CapEx story is still a huge positive for the broader economy. So I don't want to dismiss that, but we are having to look more at idiosyncratic risk. I always read the South China Morning Post to get a different perspective on what's happening in China. And this weekend, I saw that their scientists have invented a new analog chip that is much faster than some conventional computing. Okay, could we have another DeepSeek moment ahead of us? That could be one thing that could cause profit taking on tech. Could the Fed disappoint? Possibly that would be another thing that could hurt tech. If US-China, we got a truce last week. How long is that going to last? We've seen that be very fickle. So it wouldn't take much at these valuations and given this concentration to get a pullback that could have some legs to it. And if the higher end consumer loses confidence because their portfolio values are going down, you could start getting some negative momentum on this. That could weigh on the economy pretty quickly. So I'm not trying to be all doom and gloom, but I think at these levels, you have to be thinking hard about what could make it go wrong. How am I positioned to manage through that if it happens?
Absolutely. It would be irresponsible not to. Rebecca, always great insights. Rebecca Patterson, former chief investment strategist over at Bridgewater, now over at the Council on Foreign Relations. She talked about that momentum in the equity market. And well, what about momentum in private markets? The conversation up ahead with Dan Zwirn, CEO over at Arena Investors, where he's finding value as markets navigate the uncertainty.
Then we'll give you a more global view from the CEO of the global bank ING, what the financial firm's latest results reveal about the strength of Europe's economy and beyond.
And speaking of banks, Morgan Stanley made a big move last week buying the private share trading platform EquityZen. A conversation up ahead with the CEO of EquityZen. Stick with us. A lot more coming up here on The Close. This is Bloomberg.
Berkshire Hathaway's insurance business supercharging the company's earnings with underwriting profit more than tripling in the third quarter. Our next guest has cast a wide net in insurance since combining with Ceres Life Insurance a little over a year ago, using his asset management firm's specialization to source deals from around the world and across industries, including corporate loans and private credit. Joining us now, I'm pleased to say, is Dan Zwirn. He is CEO, CIO, and co-founder of Arena Investors. Dan, great to see you in person.
Thanks for having me.
So let's start there with Ceres Life Insurance. It's been a little over a year since the combination. Talk to us about what this first year has looked like and what you expect year two to look like as well.
Sure. Well, we're very excited. There are not many publicly traded integrated alternative asset managers and insurance companies, and we think it's a great model going forward because the two really work together. Thus far, our insurance company affiliate has, really done a great job pulling the infrastructure together, getting all the licenses, and is now out directly raising policies in the marketplace.
And there was a great Bloomberg News feature on you back in April talking about how you're combing the world for assets to buy with your insurer, and narrow that down a little bit. Where specifically are you looking? Where do you have conviction right now?
Well, I think when we're combing, it's really across, it goes from the kind of things that an insurer can do that are investment grade rated, largely, all the way through to the most idiosyncratic of alternatives. I would say generically, because of the way that bad monetary policy kind of intersected with bad fiscal policy starting in COVID, we saw a lot of elevated rates as well as inflation. I think we're going to continue to see that. As a result, you had a huge bubble popping, and that created this giant barbell. And on the right side of that barbell, there are opportunities in distress, like we see in, for instance, distressed real estate in Southern Europe and an emerging distressed real estate market coming in the United States. And on the new issue side, there's a plethora of opportunities across new issue lending that has basically now sees less competition, whether it's asset-based lending, factoring, commercial mortgages in kind of transitional situations, and the whole gamut of what banks used to do in specialty finance.
I am curious with regards to the asset-backed lending. I mean, what sectors, though, are you seeing the better potential return there? Because not all are the same right now.
Well, I would say people frequently conflate asset-backed finance with asset-based, right? And asset-based is a much narrower notion of lending to small middle market companies against their receivables, inventory, and machinery. That's a wonderful business. None of this really scales well, and that's been the source of some of the issues that have arisen recently. But in small bits, and you can do lots of little bits of small bits, so to speak, you're a beneficiary of the compressed margins that people are feeling with tariffs and other difficulties in the economic marketplace, when they still have hard assets that they can hypothecate. And so throughout kind of middle America, you're seeing kind of manufacturers and other peoples with squeezed margins where banks don't really want them anymore come to folks like us.
I am curious, though, but what are you seeing in terms of the, I guess, the economic conditions and the ability of some of those companies to get through whatever we're going through right now? Because there's so, at least anecdotally, you're starting to hear a lot more about pressure. I mean, it's not, no one's going under, more or less, or at least those that aren't committing fraud. But there has been some concern here about weakness, particularly with a lot of the consumer-facing companies.
Well, I think it's not just consumer. I think everybody's thinking about the escalated pricing of their materials and labor, and thinking about how do I pass through prices. It hasn't stopped, and I think we're going to see continued pressure, particularly as our currency has been continued to be defaced. And so, people are, if you talk to a small middle market company, in the manufacturing area in the middle of the United States, margins are definitely under pressure. And so there are certainly wonderful businesses that are highly free cash flow generative in enterprise software and healthcare services, but a lot of those have been kind of materially over levered over the last decade.
Well, to that point, you were recently quoted in a Bloomberg article talking about what we saw with First Brands, et cetera. And you made the point that there's been a lot of overcapitalization. And I wanted to talk about that a little bit more and unpack what exactly that means and how it surfaces in some of the situations that we've seen recently.
Sure. By that, I meant basically, any given business, as Warren Buffett would tell you, is just a bond, right? And that bond should trade at a premium to risk-free on a kind of post-tax unlevered free cash flow yield. And so ultimately, a certain business might be worth 8 times cash flow, but someone pays 12 times for it and borrows 7 times for it, and there's just too much money that went into that capital structure, all right? And ultimately, as people realize that the asset is only worth what it's worth, particularly as rates and inflation move up and that asset value goes down, someone's got to give. Something's got to give, and someone's got to get hurt and haircut in some way. Before that happens, they're going to go reach and try to hypothecate their hard assets or do other things to kind of strain themselves to kind of get through. Yeah. But ultimately, that long tail rationalization process that began in late 21 will kind of show itself over the next decade.
Are things sort of being hidden, I guess, some of the risk out there? Because when we talk about the circular nature of some of the direct lending deals that we've seen, or maybe particularly, to be more specific, in some of the refinancings that we've seen as well,
sure,
some of the sponsor-led lending as well. I am just curious as to whether that is truly sort of a strategic business case for doing those deals,
right,
or there's something else there that we should be concerned about. And this gets to the Tricolor deal and the First Brands deal, and the idea that people saw things, and we now know that because we know a lot of firms managed to get out before things became public.
Well, I would say generically, as Munger used to say, show me an incentive and I'll show you an outcome. And so what you see a lot in a lot of capital structures is let's push it till tomorrow. Let's do an amend and extend. Let's do a liability management exercise. Let's all cooperate and no one sells the debt so that we don't have to show the price. And all of these things are showing themselves, and they include trying to hypothecate your assets. What happened in Tricolor and things of that sort is what we refer to as balkanized collateral. Right? If you are both lending to me, I need you to both see each other's collateral, or else you're not going to be sure who has what.
All right. Dan, great to have you here. Daniel Zwirn, the CIO, and co-founder over at Arena Investors. When we come back, we're going to go back to the big story in AI with a closer look at Microsoft and that $2 billion in AI investments that it announced just today alone. This is The Close on Bloomberg. Let's get right to our top calls. Big movers on the back of analyst recommendations. And we start off today with Cisco. UBS upgrading to buy, lifting the price target to 88. The analyst saying Cisco has secured at least $2 billion in AI infrastructure orders this year alone and sees that as the start of a multi-year growth cycle. Next up, Roku. Piper Sandler raising their overweight, boosting the price target to 135. That's on the heels of Roku upping its full-year revenue guidance last week. And finally, let's take a look at Nvidia. Loop Capital boosting its $250 price target to a street-high $350. That implies a 70% jump in the share price over the next 12 months to an unprecedented market capitalization of $8.5 trillion. Those shares right now trading at a record high, and those are some of our top calls as we stay in that space with an eye on the Mag 7 and an eye on one of Nvidia's big peers and business partners, Microsoft, signing a nearly $10 billion deal with the data center firm Iron. Microsoft also announcing it plans to invest more than $7.9 billion on data centers, cloud computing, and employees in the UAE over the next 4 years. Rishi Jaluria joins us right now, Managing Director of Software Equity Research at RBC Capital Markets. And Rishi, I do want to start, first of all, with that Iron deal. On the surface, doesn't seem like a whole lot of money for Microsoft, given what it's already committed to other projects. But what did you make of the particular timing of the announcement on that?
Yeah, absolutely. Thanks so much for having me. Look, I think there's two things that I would signal from this. Number one is Microsoft, as they told us last week, remains very capacity constrained on AI demand, that there's just so much more demand than even they would have expected in their bullish forecast. Obviously, most of that coming from the model providers, that they just don't have enough capacity. And so they need to rely on third-party providers and data centers in order to meet that demand. And I think this Iron deal is a continuation of that. But I also think it's signaling that Microsoft is continuing to diversify their bets. If you recall, Microsoft had a deal signed with Oracle Cloud Infrastructure, but Oracle's also a rival to Microsoft. And you see them, they have deals with CoreWeave, they have deals with Nebius, and now you have Iron in this. I think this is Microsoft recognizing that not only do they have to use third-party providers, at least for the time being, but they also want to diversify it so they're not too dependent on one and not strengthening up any of their rivals too much.
Yeah, it's interesting, again, to go back to the timing, to see this big spend coming. It seems like yesterday, or not yesterday, last week, that is, those plans, the spending plans announced by Microsoft and some of its peers as well, was met with skepticism from investors. And to the point that you're speaking about, I mean, Microsoft CFO Amy Hood was talking about how you have demand increasing and how Microsoft has not been able to catch up. But still, it seems like there is this lingering skepticism on the part of investors, Rishi, and I wonder what you make of that.
Yeah, I think rightfully so. Look, I'm a huge bull on AI. I think it's going to transform society as we know it over the next decades. But really, if we think about like where is all this, unprecedented AI demand coming from? It's really coming from the companies building the models, right? Whether it's OpenAI, Anthropic, xAI, Google Gemini internally. That's really where it's coming from. At the same time, it feels like we've seen enterprise AI demand actually slow down after a big inflection earlier this year. And when I talk about enterprise AI demand, I'm talking about the Fortune 500 and the Global 2000 outside of these sort of companies. And really, this feels like this is a lot of infrastructure to build out those large models. And I think the way this works out is if these models get better and can actually enable a lot of these use cases that have so far remained elusive from traditional enterprises, we could see that happen. But for right now, we continue to see this productivity paradox where, all the stats are fantastic around productivity improvements from AI, but it's not showing up on a coordinated level at the enterprise level just yet. And I think it's going to take a while before we start to see that. And that's why I think we see this bifurcation of there's unprecedented AI demand from again, the likes of OpenAI and Anthropic and xAI, but it's not coming from traditional enterprises just yet because they're mostly mired in the pilot and proof of concept stage.
But are you somewhat comfortable, though, at least with the valuations as you look long term? I mean, it seems like everything you just said, I was thinking about later tonight, we're going to get Palantir earnings, and that's kind of like a classic case of this issue. I mean, we've seen the growth of certainly not necessarily commensurate with the increase in share price, which has sort of outpaced that growth. But people seem to be betting, Rishi, on this idea that long term that will catch up.
Yeah, look, I think there's two things I would say here. Number one is we have to bet on exactly the long-term durable AI benefits. And to that takes me to point number two. I think it's really important to think about like where the benefit's going to happen over a durable perspective, right? It's one thing if we're talking about GPU allocation and infrastructure, but at a certain point where more of the AI workloads tend towards inferencing and reasoning and starts to move into the application layer, we may not need to do this kind of arms race and training. And that's why I continue to like Microsoft at 35 times GAAP earnings, which is still, I think, very reasonable for a company that can benefit from AI, not just at the infrastructure layer, but everywhere throughout the stack.
All right, Rishi, got to leave it there. That is Rishi Jaluria, Managing Director of Software Equity Research over at RBC Capital Markets. Still ahead, a conversation with the CEO of ING Bank. That's coming up next. This is The Close.
3:30 p.m. here in New York. This is the countdown to the close. I'm Romaine Bostick.
And I'm Katie Greifeld, about 30 minutes away from those closing bells. Not a ton of activity at the big benchmark level, up about 0.2%. I will say, though, that volume is about 16% higher than normal, though.
Yeah, kind of interesting, though, but the price action is somewhat tepid, and maybe a market still kind of trying to parse the slew of earnings that we're going to get later this week. We got a couple big ones tonight, including out of Palantir, which could be interesting for the market. But also, I kind of feel like there's still this wait for kind of what's going on in the economy. The idea that we're still in this government shutdown, we're not getting official government data, and people are kind of flying blind to a certain extent, and it'll be interesting to see how much further that goes.
Absolutely. You think about what we were supposed to get this coming Friday, non-farm payrolls, not going to happen exactly.
Do we get the farm payrolls?
I don't think we do.
Why do we only quote non-farm? Have we ever just quoted the farm payrolls?
You know, it's a really good question. And
what about the farmers, Katie?
I'm going to find you an answer. But a big part of the discussion when it comes to the health of our markets is the economy, as discussed, both here in the U.S. and around the globe. Earlier today, we sat down with Steven van Rijswijk. He is the CEO and chairman over at ING Bank to get his perspective on the European economy and which countries are showing signs of strength.
The first point I want to make on our quarterly three figures was the growth. We grew our primary mobile customers with about 200,000. We try to grow our customers on an annual basis with about 1 million. Now, if you look now back Q3 on Q3, We came up with about 1.1 million, so that's good. The second lever we pull to grow is fees, so less dependency on interest income. There you saw that our fees grew in the third quarter compared to the same quarter last year with 15%. So that's really good, more diversification. And last but not least, also lending growth was good with 14 billion. On average, we grow our lending with about 3 to 4% per annum. This time around, if you look, it is about 7% compared to the same quarter last year. So we grow really well. And diversification is the key word because we have a bank that is 80% dependent on interest income, 20% fees, and we want to grow that fee part.
And we're sitting here in New York City, of course, and we spent a lot of time talking about the American economy. I would love to get your perspective on what is happening in Europe right now, because you talked a little bit about, of course, the payouts that you plan to make. And there's this idea that, you know, choosing to be a little bit more cautious on drawing down your reserves has been taken as maybe a signal that there's some caution about the economy ahead. And I would love to hear your thoughts on which direction you think things are going.
Yeah, we increased our capital reserves a little bit because there has been a bit of creep in our capital requirements in Europe, especially counter-cyclical buffers have been going up over the past 5 years. And that's why we want to have a good cushion between our actual requirements and, let's say, the buffer that we have. And that's why we moved our capital level up to around 13% CET1. But in general, I think despite the fact that we thought in the past 6 to 9 months there would be a recession in Europe, that risk has come down a little bit. We see Europe grow close to 2%, a little bit lower than the US, but still positive. There is a bit more discussion about making more investments in Europe. For example, you see in Germany a 500 billion infrastructure fund. You see talk about defense investments. You see talk about digital investments. So there is more a business acumen in Europe than there was, let's say, a year ago, maybe also on the back of the Draghi report. So that was also a bit of a wake-up call. So the talk is good, but we still need to do more in action to invest more in Europe.
Absolutely. I mean, just taking a look at the performance of the European stock market this year, I think that has surprised many people. It seems like European defense is one of the talking points of the moment. But talk to us about how that economic activity, that it seems that recession risk is a little bit lower than maybe it has been in previous months. How is that translated into deal making from where you're sitting? We've seen a little bit of a resurgence when it comes to the American side of things. Have we seen a similar pickup when it comes to Europe?
It's starting, and we saw it in the third quarter because we had a lot of deal activity, or at least deal pipeline, in the first and second quarter, especially in our wholesale bank. That did not convert into real transactions, but in the third quarter you saw it coming through. Big lending volume in wholesale banking that grew with about 7 billion, and a very large portion that also translated in lending fees and financial markets fees that we did not see in the first 2 quarters. So we had a stellar quarter for the wholesale bank. So it's a bit early to call whether that will be consistent or not, but these are positive signs.
Is this something that I think is, I guess, specific to Europe? Are we going to see, I guess, an opening of this market in terms of capital markets over in Europe in a way that I think has been lacking, at least relative to what we've seen in the US over the past couple of decades?
One thing that could help Europe is if we have a savings and investment union. If we currently look at Europe, we have a 16, 17 trillion GDP. We have a 12 trillion amount of savings sitting in the banks. But if we could invest that more into European companies, European stocks, that would help as well. That has now been an ongoing conversation in the European Union and the European Committee. If we could do that, that would really help furthering and boosting investment into Europe.
What's the fear amongst regulators in actually approving that?
I think that the difficulty is not so much that there is fear, but there's different fiscal regimes, how to really stimulate private investors to invest. It also means a different stance towards people investing rather than saving. So there's one discussion about how good is it for Europeans to invest versus to keep your money safely in the bank. And secondly, how do you fiscally stimulate that? Those are the 2 discussions on the table.
And I mean, speaking of that sort of question, investing versus saving, something that we've seen really in the last couple of years is this big rush into money market funds when it comes to U.S. consumers. This idea that perhaps they're taking what would be sitting in deposits at a bank and putting them in cash and money market funds and getting that higher yield. Are you having similar discussions? Are you seeing similar trends, that sort of behavior happening in Europe?
A little bit, but that's more about private markets. So when we now look at, let's say, the type of investments that people do. So if you talk about personal banking, private banking, then you see more and more people being interested in private markets. That we haven't seen before. Investing in money markets, there are different regulatory regimes in Europe than in the US, so I don't see that coming very quickly.
And it's tempting to talk about Europe as this monolith, but let's get specific and talk about some of the different countries here, because you bring up retail banking, for example. I know that you had particular growth there. Where are you seeing the most strength coming from? What are some of the countries that are driving that growth?
Yeah. Well, for example, if you look at Germany, we have about 10 million customers in Germany, both on the private side, like personal banking and wholesale banking. There we see a lot of growth. The market is recovering from where we saw a dip in the mortgage market in the past. That is now recovering. We see more people investing. We grow our investment accounts with about 100 to 200,000 customers per quarter. So we see a lot of growth coming from there, but that also has to do with our strength of our own franchise in the market. But we also are being helped now with a more positive business climate environment in Germany, where at least the companies and the government are willing to invest. But again, that is early days, but I'm hopeful.
Has there been any discussion about maybe having some sort of partnership with some of the private capital companies? Here in the U.S., obviously, we've seen a lot of direct lenders partner with the traditional banks. One of your management board members was asked about this a few weeks ago and seemed to suggest that that actually wasn't an option right now for ING.
No, what we see as ING, we want to really grow in the particular markets. Like you said, Europe is not a monolith. Different markets behave differently in terms of regulatory regime, capital, liquidity, products, product culture even, I would say. So what we need to do is to, first of all, grow in these markets and become more specific in the services that we offer to our customers. Mm-hmm. Secondly, fill in the blanks that we have in these markets. For example, we do have business banking in Romania, Poland, Belgium and the Netherlands, but we don't have that in Germany, Spain and Italy. So fill in those blanks so we can actually grow in width and breadth of our services. But of course also if we can see companies or banks that have good customer bases there and we can take them onto our technology platform and thereby increase in scale, market by market, we will look at that as well. That is currently our priority.
Steven van Rijswijk, CEO and chairman of the executive board over at Amsterdam-based ING. Meanwhile, we turn back to the U.S. markets as we count you down to the closing bells with two of the biggest movers in the market today. Kenvue up 13%, an eye-watering rally after we learned about a deal by Kimberly-Clark to buy up the company. Kimberly-Clark actually having its worst day, going back to the 80s. It's a stock hour, and it's up next. This is The Close on Bloomberg. Kenvue shares soaring after Kimberly-Clark agreed to buy the Tylenol maker for about $40 billion, a tie-up that would create a combined entity worth about $50 billion, whose revenue would surpass Unilever and rival the top consumer health giant Procter & Gamble. Joining us right now is Norah Mulinda of Bloomberg News. All right, Norah, there are a lot of questions here. We should just point out, it was just about 2 years ago in 2023 where this company was spun out of J&J, $22 a share. I think it peaked somewhere in May of that year, the year that it was actually spun off, and hasn't done much of anything since. What exactly happened over the last 2 years? Because I thought the whole point of this spinoff was that somehow this company would somehow perform better on its own rather than as a division of J&J.
And that clearly has not been the case. I mean, you've really been seeing this company taking a beating. I mean, down about 22% so far this year. But it's not only the issues that it was having there at J&J, but even, you know, with the spin-off there, you did see a lot of mounting legal pressures that you're seeing from this company. I mean, even more recently, we heard a lot of crackdown coming down specifically on Tylenol and a lot of pregnant women's use of it and whether or not that could be potentially linked to autism. So you are hearing a lot of Wall Street really just a bit skeptical about whether or not this actually creates a certain level of exposure that maybe Kimberly-Clark doesn't want right now.
It is interesting that as a spun-off company that it didn't perform well, because you think about some of the other recent spin-offs. Bloomberg actually has an index for this, BN Spin on your Bloomberg terminal. It's sitting close to all-time highs, which is pretty amazing to think about. Some of its biggest names, GE Vernova, GE Healthcare, Sandisk, et cetera. But talk to us about what could be different for Kenvue under a Kimberly-Clark, a different conglomerate than the one it started with.
I mean, that's certainly what people are trying to get at right now. They're saying, hey, this didn't work out as an independent company after we did see the J&J spinoff. Then you are having a lot of activist investors coming in and trying to really create a turnaround story for this company, and that clearly hasn't really panned out if you're just looking simply at share performance and financials here. So then you have Kimberly-Clark coming into the mix and saying, hey, we want to take this company on, but the question is, are you going to be able to illustrate and orchestrate a potential turnaround and bring this company into a place to where it makes sense for investors to feel as though they'd like to back it?
It's interesting, too, though, they're looking at Kimberly-Clark shares. I mean, we're talking about Kenvue, but Kimberly-Clark having its worst day since 1987. So this seems to be investors kind of looking at this, existing investors, and saying, what the heck's going on? Is there, though, the potential here? Have you talked to anyone who thinks that maybe the CEO could unlock some value out of Kenvue that they weren't able to do on their own, and frankly, what they couldn't do under J&J?
Well, a lot of analysts are saying it remains to be seen. I mean, a lot of people are really looking at this company with such a critical eye to say, hey, why are we making this decision? And they're saying that it's going to take a little bit longer for us to actually be able to see whether or not it is a sort of payoff that makes sense in a way that they should be moving forward with this deal here.
Right. Well, apparently this is expected to close in the second half of 2026, so
they make
remains
more
to
than
be seen.
Tylenol, right, Katie?
They have a whole
Listerine,
portfolio. We showed a gorgeous
Aveeno,
Listerine, yeah, Band-Aids.
Neutrogena, yeah.
Yeah, I used to use a lot of those.
Household favorites.
I try not to cut myself anymore.
Norah, Mulinda, great reporting. Coming up next, we're driving to the closing bells. We'll take you there with George Maris of Principal Asset Management. This is The Close.
There is a lot of disconnects here. I almost think of it like a Jenga game. It keeps getting taller. GDP is going up. Equities are going up, but it's getting wobblier. And that means that there's more risk that as investors we need to think about.
Rebecca Patterson, former chief investment strategist over at Bridgewater. She kicked us off to the close, a conversation about economic conditions and a lot of people trying to find any type of data, Katie Greifeld, they can get their hands on to find out where the economy's heading.
Thank goodness we're in the heart of earnings season, so we at least have some numbers coming from corporate America. I will say it's interesting to take a look at the makeup of the market today. The S&P 500 looks like, we'll see what happens in the next 10 minutes. Trying to stay in the green right now.
Is that going to change in 10 minutes?
It could. Anything could happen. Now 9 minutes. It's interesting, though, to see how narrow the breadth is right now. Fewer than 200 names in the green, even with the likes of Nvidia, Amazon, Tesla, some of your biggest gainers in the S&P 500 right now. On the other side, you have Apple, Broadcom, and Meta. So a real tug of war here, Romaine.
Absolutely. And we get to this idea here of, can we live with a narrow
Can
market?
we? Yeah.
It's
a need to have. You need to have big tech. It's nice to have a big, beautiful, broad rally, but maybe you just need big tech to participate.
All right. Well, they're doing more than participating. They're doing all the heavy lifting. We get some more big tech earnings after the bell tonight, including from Palantir. Also, a few smaller companies as well that we'll keep an eye on, like Goodyear, Clorox, and Qorvo. George Maris joins us right now, Chief Investment Officer and Global Head of Equities at Principal Asset Management. And George, I do want to start off with the earnings season. We've gotten through a big chunk of it, at least for the big companies that really matter. And so far, I guess so good in terms of investor expectations going into it. But as you look out into over the next couple of quarters, do you see that earnings momentum continuing?
So right now, they look like it's going to continue, and especially if you look at it in a global perspective, we're seeing European revisions going up. We're seeing Asian revisions going up. I think the key question is the sustainability of the consumer in the U.S. and these tech earnings. A lot of questions in terms of a lot of the CapEx with respect to AI and the hyperscalers. Is it going to be productive? And if it's not, we could certainly see risks to 2026.
When we talk about the risk in 2026, George, what exactly are we talking about? Is this a concern about the economy, a concern about valuations? What?
Well, I think all of it's in play. First of all, it's, the U.S. market's at 25 times forward. Even ex-U.S., we're trading at 17 times forward in Europe, 25 times in Japan. We're no longer sitting on what we'd consider cheap valuations, at least relative to history. Now, a lot of that's fueled by secular growth in technology, but clearly we're in a place we haven't been terribly often. And when we've gotten here before, there's been a reversion. So it's got to be driven by earnings. If we don't have that earnings fuel, what gives? A lot of that earnings right now is certainly driven by what's happening in advanced tech. And if we're not seeing, high-end compute continue to drive things, we'll have a reset.
Well,
we'll certainly
George,
be subject to it.
with that in mind, what do you make of the earnings that we just sorted through? When it comes to last week, a whole bunch of the Magnificent Seven names reporting last week alone. We still have to wait a couple of weeks for Nvidia. That's your lone outlier. But when you think about what we heard in terms of numbers, what we heard from the executives in terms of where they see, especially this AI storyline going from here, it seems like all steam ahead. Does that look to be the case from where you're sitting as well?
Well, I think there's two parts to that, Katie. I think the first part is it does look all steam ahead. They've got substantial order bookings going ahead, tremendous opportunity in front of them. I think the real question, though, becomes a second order effect, and that is what's the productivity of the spend? You know, we're hearing about 2030 revenue numbers from these companies, but who knows, right? We don't know whether or not the spend will lead to the kind of productivity we all think it will. And if that doesn't turn out to be the case, we are sitting in a vulnerable position. That said, we could be blowing through everything as well. So I think it makes now a very tenuous period. And the markets, look, the markets last week told you that, right? Where we had some really strong earnings, but where we had significant CapEx spend, let's say, for example, Meta, the market did react well.
Yeah, absolutely. You saw that, too, in Microsoft when talking about Meta, that sort of skepticism over some of these huge numbers that they're putting up in terms of planned spend. But I want to talk about the intersection of this in the equity markets, but also the debt markets. This is something we'll be talking about on the close, that you think about Meta, again, tapping both the public and the private markets. You also have Alphabet out with a jumbo bond sale to fuel these ambitions. I wonder the fact that you're seeing a lot of these big tech giants who for at least the last decade or so haven't been that active in the bond market really come in and issue so much debt. Does that change how you think about them as equity investments?
Well, it tells you that it's no longer a layup from the equity side that it has been before, right? It's the easiest thing to do is to go ahead and just fund it yourself, issue shares, and self-fund. The fact that you no longer can, one, means the liquidity demands are higher, but secondarily, it means that you're trying to diversify your risk. I think it's a really interesting insight here, Katie, that you're seeing CDS spreads in a lot of these companies start to widen out, for example, Oracle, at the same time as the stock prices continue to rip, i.e. the fixed income and equity markets aren't necessarily aligned, and I think that's something to know.
Does that matter? I mean, Katie's question was good, George, but I just want to kind of build on it. I mean, I'm no Haverford grad like her, so forgive me if this doesn't sound as intelligent. But does that matter in the context of making investments right now? I mean, is that something that you genuinely have to sort of factor in before you enter into a new position?
So, Romain, great question. I would tell you if you're worried about tomorrow or this week, probably not. But if you're a true longer-term investor, absolutely. You have to get the math to work. And so you need to understand whether this spend is going to be productive or not, especially given the quantum of spend and the circularity of it. So we got to make sure that this spend actually has economic value to it. If it doesn't, it's going to be challenging to get any sort of good return.
All right, George, really interesting that you didn't necessarily put in the fact that you're a Swarthmore graduate to Romain's question.
Well, I didn't want to embarrass myself any further than I already would, but thank you for that.
All right, George, appreciate you taking time for us. George Maris there, Chief Investment Officer, Global Head of Equities over at Principal Asset Management. As we count you down to the closing bells, Katie Greifeld with just about 3 minutes until we get to those bells. You got the S&P and the Nasdaq holding into the green. Everything else in the red, though, we should point out, fractionally so here. So modest losses for some of the other indices.
Yeah, absolutely. It is interesting to see the Russell 2000 perhaps fall off a little bit more here. Some interesting movements in the bond market, talking about treasuries proper, that you have seen yields creep back up in the past really week or so since we got that Federal Reserve meeting. And maybe that's what's going on with some of these small caps, that hope for a rate cut, maybe fueling the dream once again that we might see the Russell 2000 outperform. It looks like that dream is delayed once again. Absolutely here. And a lot of catalysts out there for the market this week with the government shutdown now looking like it is going to become officially the longest in history. A slew of earnings coming after the bell tonight. And of course, some key elections going on around the country, including here in New York City as well as in Virginia. Looking forward to your coverage in New Jersey, too. Don't forget New Jersey, of course. A good I won't forget it. Yeah. I mean, they said, where would you want to go? Where would you want to spend your Tuesday afternoon? New Jersey. Where else? New Jersey. This is The Close.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now we are 2 minutes away from the end of the trading day. Romaine Bostic here with Katie Greifeld, taking you through to that closing bell. It's a global simulcast. It starts now. Carol Massar, Tim Stenovic, they're in the radio booth. Welcome to our audiences across all of our Bloomberg platforms, including our partnership with YouTube. Here on a relatively modest day in financial markets, Carol Massar, the market waiting on something.
Yeah, it is waiting on something. I'm not quite sure. I think with the Fed speakers out, we saw Lisa Cook making some comments, seeing the risk of further labor market weakness as greater than the risk that inflation will pick up. But she also stopped short of endorsing another interest rate cut next month. So I feel like, I don't know, we are looking for something to hold on to here.
I was asking Megan Horniman all about valuations, given that there are some folks out there who say things are a little lofty right now. She said, okay, we're not going to talk like, it's the tech bubble of the 90s and early 2000s again. She did say bubble-like. She said bubble-like, though, but
bubble-like.
But not a bubble. Bubble-like.
Yeah. We're all
Aren't we always in a bubble?
Somewhere.
Who said that last week?
I know. Yeah, thanks for watching our program.
Yeah,
there you go. It's always a bubble somewhere. It's always 5 o'clock somewhere. I do think it's interesting, though, that skepticism seems to be coming back. You remember a few quarters ago, the narrative was all about ROI on spending from some of these big tech companies. When are we going to see it? Are we overspending here? It seems like that has sort of snuck its way back into the narrative around this earnings season as well. When you think about the reactions to Meta in particular, but also Microsoft to some degree.
Microsoft, yeah, the big Alphabet bond sale starting to unfold here. I mean, we're talking about a sale coming in at $15 billion and ended up coming in at $17.5, and they had, at least based on people familiar with the situation, $90 billion in demand for that. So it shows you whether we're in a bubble or not, investors, at least for right now, still want a piece of it. And that is kind of reflected on your screen there with the Dow Jones Industrial Average in the red, but the Nasdaq in the green. The Dow down more than 200 points or a half a percentage point. The Nasdaq Composite up a half a percentage point. The S&P is going to finish in the green, up 0.2%. And Carol, the Russell 2000 down 0.3%. All
right, right now we do have some earnings crossing the Bloomberg terminal. We have Corvo crossing, and let me just bring it up here. And we're looking at second quarter adjusted revenue, folks. Slight beat, 1.1 billion. The estimate on the street was 1.04 billion. And second quarter adjusted earnings per share, $2.22 a share. That's 11 cents better than what the street was expecting. It's a semi-device company. Stock's been on a run, like a lot in the semi space. It's up more than 30% year to date. Right now, we're seeing initially that stock unchanged in the after hours.
And we should point out, of course, they're being bought by Skyworks, so you're not going to see a whole lot of movement in the shares given the pop that you had last week.
All right, good stuff. Thank you for that. All right, S&P 500.
Value add, Carol Massar.
What?
Value add.
That's what we say here.
Do you know I'm going to spend tomorrow in New Jersey?
What?
Yeah, pray for me.
In Jersey City, actually.
Is this part of the election special?
No. They decided they want me out of the studio.
Okay.
Yeah, he's in timeout in New Jersey.
They should just send Katie. She's right there.
Wait, who wants you out?
No.
Everyone.
Tell us who they are.
It's a joke. He'll be doing election
We're going to talk to
coverage.
somebody for you.
Good.
Okay. So S&P 500, folks, most names in the index lower today. 316, Katie, to the downside, 185 to the upside, and 3 unchanged.
Similar story when you take a look at the sectors in terms of the breadth performance. You did finish in the green, but you only had 4 sectors actually rising on this Monday, the first trading day of November. Consumer discretionary, that's just another word for tech, with Amazon having a heavyweight there. You did see tech perform as well. So too did healthcare and utilities. What didn't do too hot today, materials, consumer staples, and financials, some of your biggest losers on the sector level, Carol.
All right, let's get to some of the individual gainers. Got to mention Amazon, up 4% by the close for a 2-day gain of just about 15%. Analysts raising price targets for Amazon since the company reported earnings last week. 45 raising price targets by an average of 11%, no cutting their price targets. And then, of course, you had their cloud unit doing a mega deal, $38 billion deal to supply a slice of OpenAI's bottomless demand for computing power. And we did see the stock definitely jumping on that news. So we continue to see that. Hey,
what exactly are all these servers doing, by the way?
We just talked to Mandeep Singh, and I'm like, are there servers sitting empty just waiting? And he's like, no, the build out continues. You see supply constraints. We saw that with some of the hyperscalers last week, that they just can't meet demand, and yet you're seeing some strong numbers. We certainly saw that with Alphabet. So I don't know. The ROI and the demand is still there. So I don't know. We're trying to figure that out too. On a related matter, Cipher Mining, I want to bring up. They also finished with quite a rally, up as much as 34% in today's session, finishing with a gain of about 22%. This company signed a $5.5 billion 15-year lease agreement with Amazon to provide turnkey space and power for AI workloads. So again, that AI build and spend, as you mentioned, remain continuing. And then I got to mention Kenvue, up about 12%. This has Kimberly Clark agreed to buy the company for roughly $40 billion. A lot of questions about that one in terms of the Tylenol exposure. We'll have to see how that one plays out. But nonetheless, some outperformance there.
Kimberly Clark investors have a lot of questions about this deal. That's where I want to start with today's decliners. Look at this. Kimberly Clark down 14.6%. This is the worst single day going back to October of 1987. Do you guys remember what happened in October of 1987?
I do, actually, but I don't want to spoil it for you.
Black Monday.
Yes.
This is the worst day going back to October 19th, 1987. Kimberly Clark shares slumping. The company agreeing to buy Kenvue in cash and stock deal, an enterprise value of $48.7 billion.
Read up on that.
What's that?
Black Monday?
Yeah.
You need a
that
refresher?
was before I was born.
You're still stuck.
Oh, yeah.
We were,
Wait,
Romaine,
you
we were
weren't
born. Katie was not.
God.
Yeah.
He's pulling your leg.
Okay. All right. Anyway, let's keep going. We got some more decliners.
Now you know why they're exiling me
I feel like we spent a lot of time on this deal already. Okay, so we know what's going on. Charter Communication shares also falling today, 5% lower. KeyBank Capital Markets downgraded the cable company to sector weight from overweight. And then 9 analysts, since the company came out with earnings on Friday, have cut price targets by an average of 17%. No analysts raised their price targets. Shares taking a hit by 5% today. And rare earth stocks also in the red today, focusing specifically on MP Materials, falling 8.6%. The White House announced that China will effectively suspend implementation of additional export controls on rare earth metals. Still, MP Materials up 280% so far this year.
Palantir earnings crossing the wire right now. The stock hit a record high in the cash session. Looks like it's higher here in the after-hours trade. Adjusted EPS in the most recent quarter, a big beat, 21 cents a share. The street was looking for 17 cents. Revenue coming in at about $1.2 billion. The street looking for 1.1. Here's your guidance. The company says that for its fourth quarter, it sees revenue basically at $1.33 billion. The street was looking for $1.2 billion. The company also says that it expects for the full year to close out the full year here with operating profit of $2.15 to $2.16 billion. Also well above street estimates. That average was at about $1.93 billion. So looks like a beat and raise quarter here for, of course, one of the biggest darlings in the market right now.
Yeah, absolutely. And it seems like the raise is particularly what's exciting the shares after hours. As you said, boosting their full year revenue forecast. You can see shares up by about 4.5% after hours, Tim, which is pretty amazing when you consider that this company was up more than 170% through today's close through 2025. So the expectations were high, but the first blush read here is that this is more good news.
Alex Karp talking about the good news. He's the co-founder and CEO of Palantir. He says year-over-year growth in our U.S. business surged to 77%. Year-over-year growth in U.S. commercial climbed to 121%. We are yet again announcing the highest sequential quarterly revenue growth guide in our company's history, representing 61% year-over-year growth. Shares up another 2% in the after hours.
Top quiz. Palantir is not the best performing stock in the S&P 500, despite the fact that it's up 170-something%.
What is?
Okay, well, that was the quiz for you, Carol. I guess you're not good at quizzes. It's Robinhood, which is up about 300%.
Your toes, they're tough. Yeah. Hey, listen, Palantir was looking, the expectations were for revenue growth of about 50%. So we actually saw revenue increase 63% to that $1.18 billion in the period ending in September. So that was some outperformance. I'm just looking at Lizette Chapman writing through. So raising its annual revenue outlook to $4.4 billion and outpaced analyst estimates for third quarter sales, citing accelerating and otherworldly growth for its AI and data analytics products. So again, that AI trade alive and kicking for a stock, as you mentioned, remain up 173% year to date.
We'll continue to follow Palantir. Let's quickly, though, talk about Hims & Hers Health reporting earnings. Their third quarter revenue beat estimates as well. You take a look at the look ahead. They see fourth quarter adjusted EBITDA between $55 million to $65 million. The estimate had been for $74 million. So a bit disappointing relative to expectations when it comes to the look ahead. Hims & Hers Health, one of your big outperformers this year, up more than 80%. You take a look at the after hours trade, though, for Hims & Hers Health. A bit of a spike lower, but traders deciding what to do.
All right. Yeah. And this is a stock that certainly has bounced a bunch. Hey, Palantir, just a quick check, guys, up about 3% here in the aftermarket. All right. That's a wrap. Our cross-platform on radio, TV, YouTube.
We're going to miss you guys.
You guys are leaving, too.
We're
You'll
leaving.
be somewhere else tomorrow.
So is Katie the only one here tomorrow?
Kind of, yeah.
Where are you going?
We're going to Denver.
Okay.
Mile High City.
Yeah.
Okay.
All right.
Yeah, so we'll be there. Don't worry. I think Matt and Katie will be here tomorrow in our studio.
Theoretically.
So.
Well.
Yeah.
Okay.
Right,
Sounds suspicious, but we'll see.
It's work, I promise. All right, guys, take care. We'll see you again. That is a wrap, our cross-platform. Katie and Romain, of course, continuing there on the close on BTV. Tim and I continuing on Bloomberg Business Week Daily right here on Bloomberg Radio. We will see you, well, not until Friday.
And coming into today, we should point out Palantir had a price to sales multiple of 85. Investors not too concerned. That stock closed at a record high in the cash session. It's rising higher in the after hours after a beat and raise quarter from the data company. Gil Luria over at DA Davidson. He joins us after the break to break down those earnings out of Palantir. This is The Close on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Katie Greifeld.
And I'm Romain Bostic. Of course, we start this Monday with fractional gains for the broader market. Gains that were largely fueled by, well, what else? Technology and AI. We saw a flurry of deals in that space, which helped to lift the market. Well, just a bit. The S&P up 0.2% on the day. You had a little bit more of a pop in the Nasdaq, but as you can see, it was the Mag 7, those big cap tech stocks that once again ruled the day. No real dice for the Russell 2000 and no real juice right now for some of the individual sectors like healthcare. Right now, Katie Greifeld, tech is the trade.
Absolutely. Let's talk a little bit more about tech, but I'll start actually with Kimberly-Clark first because, boy, what a wipeout. We know the story by now. Of course, that deal to buy Kenvue, $40 billion. You're looking at Kimberly-Clark's worst day since October 1987. Not a superlative anyone likes to hear, but it really was all about big tech. And that takes us actually to our top story this hour, and that is tech stocks rallying in a big way as Amazon inks a $38 billion deal with OpenAI, really adding fuel to that AI trade. Meanwhile, as Romain has been mentioning, Alphabet looking to sell about $25 billion of bonds in the U.S. and in Europe, building on the AI borrowing wave, and Microsoft signing a $9.7 billion deal with data center firm Iron. That slew of tech news coming ahead of those Palantir results just crossing the wire, Romain. And you can see traders trying to decide what to do in the after-hours trade for one of the hottest stocks on Wall Street this year.
And the reason why it's hot, Katie, take a listen to this. Revenue up 63% in the most recent period to $1.18 billion. Saw a decent performance here on the bottom line as well. And more importantly, the guidance for the current quarter, the full year, if you will. The idea here that some of those gains can continue. The shares, which had been up about 6% in the after-hours trade, now almost unchanged. Gil Luria joins us right now, head of technology research at DA Davidson. And Gil, I don't think anyone came into this quarter not expecting that type of growth. The concern was that you have this type of growth, but you've had even more phenomenal growth in the company's multiples with regards to its stock valuation. And I'm wondering if you're comfortable with where those valuations sit based on what we know publicly.
Well, it's very hard to argue whether Palantir should trade at 85 times or 100 times or 70 times, right? All these numbers are completely disengaged from fundamentals. This really is about the fact that this company is doing so unbelievably well. This is by far the best software company, and they keep raising the bar for themselves at a level that nobody else is even close to. This is a company with a $4 billion run rate that's growing 63%. There's nothing even remotely close to that, which is how we got to the situation where valuations are at unprecedented levels, not just for them, but for any software company. And that seems to persist as long as they can continue to raise the bar. Let's not forget, that 63% is an acceleration from the 50% last quarter, which was faster than the quarter before that. They continue to accelerate. They're doing phenomenally well on both sides of the business, the government and the commercial.
Yeah.
And that doesn't seem to be slowing down.
Well, let's talk about that. And we should point out that Alex Karp was interviewed a little bit earlier today, and the idea that he says, in his words, we're in, quote, nosebleed zone. But I want to talk about the commercial side of the business, the government business, which, remember, when they went public, that was a big criticism that they were so heavily dependent on government contracts. That revenue was up 50%, but the commercial side of the business more than doubled in the most recent quarter alone. Do you think this becomes a company where we're going to be talking more about the commercial side of the business than the government?
Yes. Within a year or two, the commercial side is going to be bigger. What's happening is all these companies, all the companies in the world want to have an AI strategy, an AI product, deliver insights using artificial intelligence, and they have to cobble together different software solutions and then hire a third-party consultant and internal people in order to implement it. Palantir comes to those same companies and says, just give us the keys. We will give you an AI solution on the other side of that. We'll do all of the above. We'll bring the software we have, we'll implement it for you, we'll run it for you, and you will have an AI solution. And they've been able to deliver that customer by customer to an extent that they've now become the leading provider of AI solutions, and which is bringing them more customers, and they're expanding their relationship within the existing customers. And interestingly, they're the only company that's been able to execute that so well. That is why they have more than 50% operating margins on top of the 63% revenue growth.
It's interesting, though. I mean, when you think about the division between government work and the commercial business, I mean, you take a look at the government work in the U.S., it increased 52% in the third quarter. When you think about the business going forward, what do you think the breakdown between the two sides are in terms of which commands the lion's share?
Within a year or two, the commercial side will be bigger. That's just because it's doubling while the government side is growing 50%. Now, growing any government business 50% is also admirable. That has to do with an alignment of mission, an alignment with the fact that Palantir can develop tools with its software where the government used to develop its own software. Palantir is capable of doing bigger and bigger projects. But the one important thing to remember that's true across government and commercial is that Palantir's magic is that it can take disparate data from different sources and combine it in a safe, private way so it can be used for AI. That's valuable on the commercial side. It's that much more valuable on the government side. So the growth rates there are incredible. It's just that the growth rates on the commercial side are even more staggering.
And Gil, this isn't necessarily about their business, but when I think about Palantir, I think about its strong retail shareholder base. It's very popular among self-directed investors, and it has, I mean, Alex Karp himself, of course, has built a loyal following. And I wonder what that means for you as, you know, someone who's charged with covering and analyzing a stock, how you factor in sort of the people that hold it to that conversation, if at all.
You have to factor. Again, that's why we got to this valuation. This isn't a valuation institutional investors would be paying on their own. The reason we're at this level of valuation is because of how excited individual investors are. And they're excited not just because of the growth rate and the fact that they recognized all these good things well ahead of institutional investors. They're excited about the mission too. Alex Karp, Dr. Karp, is not afraid to say that he wants to make software to help defend Western civilization. That's something very few companies are willing to say, and that resonates very much with individual investors that are aligned with that type of mission. So you have the fundamental performance, you have the excellent growth rate, but you also have a mission that's drawing individual investors as well, which again is why valuation has very little to do with the actual free cash flow that the company's going to generate, and has a lot more to do with how many people want to own a piece of this business.
It's fascinating, and there's a lot of parallels that you could draw to Tesla, for example, which also has a very loyal following and also has had some pretty eye-watering valuations, but also has a mission. Gil, unfortunately, we have to leave it there. Great to get some time with you. That is Gil Luria. He is head of technology research over at D.A. Davidson. Now, coming up, Morgan Stanley acquiring trading platform EquityZen. We'll speak to Equity's CEO coming up next. This is The Close on Bloomberg. Morgan Stanley buying trading platform EquityZen as part of its private markets push in the first deal for CEO Ted Pick. EquityZen CEO saying this partnership isn't about selling, it's about scaling. And I'm pleased to say he joins us now. Atish, Davda, CEO of EquityZen. Great to have you with us. So Morgan Stanley's head of wealth management told Bloomberg News in an interview that EquityZen and Morgan Stanley had been in talks for about 2 years. What finally got this deal across the finish line?
Hey, thanks for having me, Katie. Yeah, that's absolutely right. So Morgan Stanley and EquityZen have been, first of all, partners for many years. But then the last 2 years in particular, I think two things happened. One, EquityZen, 13-year-old company, we believed in the private markets from the very beginning. We began to see a real tailwind begin to pick up in the space. And Morgan Stanley, really, one of the pioneers among the large incumbent banks that has really acted to participate in private markets with their acquisition of Solium several years ago, with the equity plan services business that E-Trade brought to them, and of course now with EquityZen. And so really 2 years ago, we began planning out, well, what does the future of private markets look like? IPOs aren't happening as much. Private companies are growing. Value creation is happening in a way that's outside of the scope of most public market investors. How do we bridge that gap at scale? And the result of last week's news is what we've been working on for a while.
Well, what caught my eye about the announcement was that terms of this deal weren't disclosed. There wasn't a number value attached there. And now that news of the deal has settled, can you give us some idea of how much this deal is actually valued at?
Well, I can't give you any idea in terms of numbers. What I can tell you is EquityZen and Morgan Stanley coming together is one of those rare deals where literally every stakeholder is happy. You have EquityZen shareholders who have, are going to see a phenomenal return. You have EquityZen shareholders and employees who are themselves going to have a wonderful place to go to, and with a large capital investment that Morgan Stanley is going to make to further the mission of EquityZen. And Morgan Stanley is happy because EquityZen, by the way, is a relatively capital efficient business. We've raised the grand total of $7 million in outside capital, last raised capital 10 years ago, and have really shown that it's possible to run a profitable business, technology driven, and in our case, mission driven as well. So sorry, Katie, no numbers here, but what I can tell you is one of those rare deals where all sides are happy.
All right, Atish, we'll let you off the hook on that one. I am curious, though, about the structure of the business going forward, particularly as it relates to the relationship that you have with the companies that are listed on the platform here. They are going to have more say. Is that what I'm understanding as this gets integrated into Morgan Stanley?
Absolutely. And by the way, let me be clear. EquityZen itself ran a business independently while giving issuers, the companies, a seat at the table. So a traditional marketplace has buyers and sellers. Private company stock is a three-sided marketplace. You have buyers and sellers, but ultimately what you need is the issuer's blessing, the company to actually go ahead and say, hey, this is my cap table. This is the final record of who owns my shares. And so what EquityZen has run a business for the last 13 years is by getting the issuer's blessing, by being an issuer-friendly platform. And guess what? There's no way Morgan Stanley, with its world-class investment banking and capital markets franchise, but also on the wealth management side, they have Solium ShareWorks, they have MS at Work, they have an entire liquidity provision platform. They're all about issuer buy-in. And so I think really this was a really good match made together with two firms that believe that issuer needs to be at the center of these discussions and to give them really a much more robust remote control.
I completely understand why Morgan Stanley would be interested in your business, particularly with regards as they try to funnel more through that wealth, funnel some of these assets more through the wealth channel. But it has raised questions, as you know, about the issue of transparency and liquidity. You talk about the 13 years that you've been in business, Atish. How has that transparency and liquidity improved, if at all, through your platform?
Yeah, absolutely. Look, 13 years ago, I would say there was very little awareness of what these large private companies were doing, how large they were, even in some cases who their management team was. Today, I think even on EquityZen's platform alone, and we power the platforms of large financial publications like where folks can go and take a look at private and public company information together. We provide that information to hundreds of millions of users who want that information available. So certainly in the last decade, a lot more information is becoming available. But to your point on transparency, Romain, I think one of the key things we see is take a look at OpenAI. Now there's equity research coverage on a private stock that used to never happen before. And OpenAI is just really the first. We're going to start seeing the top 10 companies in the private markets continue to get coverage, equity initiation reports kind of across the street.
Yeah.
So is it necessarily going to be government mandated that public disclosure is available? I don't think so, not for a while. But I do see there's going to be a lot more just public market information available about private companies.
All right, Atish, we have to leave it there. Really appreciate you taking time, and we got to get you back on soon to talk about that integration. The CEO of EquityZen, Atish Davda. When we come back, the CEO of Vita Coco. This is Bloomberg. All right, a big week on the tariff front. We're awaiting a Supreme Court decision here in the U.S. that considers the legality of Trump's tariff regime, and that could affect billions of dollars of trade. One company that we are keeping an eye on is Vita Coco. Shares of the global beverage brand outperforming since Liberation Day. Tariffs began on April 2nd, despite the company's reliance on overseas supply. There to discuss more about how the business is managing tariff uncertainty is Michael Kirban. He's the co-founder and executive chairman. Great to have you here.
Thanks for having me.
I wish you point out, you had earnings last week by a beat and raise quarter. You saw a big pop in the stock, so investors seem to be pleased. Yep. You've been having to navigate the sourcing of your materials, the majority of which I assume come from outside the United States. What has that process been like over the past, 7-8 months?
Well, it's been interesting. I mean, we've got this business that's growing tremendously. Coconut water is one of the fastest growing, if not the fastest growing beverage in the entire beverage aisle. So, we're focused on growth, focused on availability and growing availability at retail. But at the same time, we're dealing with uncertainty around tariffs. So we've taken some pricing, which we did with the first round of tariffs, the initial baseline 10% tariffs. We've taken pricing to cover that. We've seen ocean freight rates decline significantly over the past months as trade has slowed, international trade, and that's helped mitigate some of the other tariff effects that we're dealing with. We're hopeful that, things continue to go well and that, as trade deals get done, the administration has been pretty clear that they're looking to exclude unavailable natural resources, coconuts and other things, and so we're hopeful that we'll see some relief there also.
So it's not only just the natural ingredients that go into that bottle, so to speak, but it's also the packaging itself. Is any of the packaging that you have also affected by tariffs?
Finished goods.
Yeah.
So we look at, tariffs are assessed on finished goods coming into the country. And it's part of the process.
So just to be clear, so you're just paying on the finished product, more or less, not necessarily paying on the coconuts, paying on the packaging, and then on whatever you ship. So most of that is bottled overseas and then brought in.
Yeah, everything is produced at source, brought in, ready to go to retail. And that is where the tariffs are assessed.
Gotcha.
Yeah.
It's interesting, and you say that you've taken some pricing to mitigate the effects of some of those tariffs. How many times can you pull that lever? How do you think about that from where you're sitting, especially you evaluate the strength of the consumer?
Yeah, so like you mentioned, this consumer is very strong in coconut water specifically, and in beverages that are functional. So people are buying protein drinks, they're buying energy drinks, they're buying coconut water. That's what's growing today. And so we feel that we're in a very good position price-wise. We've taken very little price over the last 4 or 5 years in relation to other beverages across the beverage aisle. The price that we took to cover the initial 10% tariffs, we took it earlier this year. And we haven't seen much of an effect. So the consumer seems willing to pay. Again, we have other offsets, other mitigating efforts that are working, and we'll measure it as we see what actually happens with tariffs for unavailable natural resources and decide if we need to take more pricing coming into 26.
Well, while we have you here, I do want to talk a little bit about beverage trends. You mentioned a few of them when it comes to energy, when it comes to protein. Of course, Romain had a great conversation with the CEO of Starbucks last week. They're one of the companies that's really hopping on the protein trend, fiber as well. How do you sort of keep up and evaluate with the different trends that emerge, specifically when it comes to the beverage landscape, and decide whether or not that's something that you also want to hitch your wagon to?
Well, I think, consumers, again, they're willing to pay for products that offer something besides just basic, thirst quench, basically something to drink, right? So we feel that as we look across the beverage aisle, those are the areas that are growing. hydration is key. So we think that coconut water is playing into this hydration time, which people are, very interested in and paying for. But also, as you look at things like protein and things like energy, we believe that we have the ability to play in other spaces also.
But there's a lot of competition in this space. And I mean, anyone who's been in any kind of grocery store knows, I mean, you have a pretty prominent shelf space, at least in most of the grocery stores I have traffic in here. But there's also a lot of other coconut water brands out there and other sort of, I guess, hydration, thirst quenchers, if you will, spins on that, not necessarily coconut. So how do you sort of stay, I guess, ahead of some of those other competitors?
So if you think about coconut water in general, we're by far the largest player in the industry. I mean, we have almost 50% market share in the US. The nearest competitor has sub 10. So we have a pretty strong position in the market. In our other large markets like the UK, we have almost a 90 share. So we're in a very good position. And, we think that as you look across hydration in general, people are looking for natural products today, natural alternatives to artificial sport drinks like Gatorade and others that are, filled with sugar and all sorts of coloring. We think, when the product comes right out of a tree and is 3.5 times the electrolytes of the leading sport drink, that's something consumers are interested in and excited about.
All right, Mike, great to get some time with you. Really interesting conversation. That is Mike Kirban. He is co-founder and executive chairman of Vita Coco, rather. Meanwhile, let's take a look at some of the notable movers in after-hours trading. Earnings season still in full effect here. You can see Palantir up just marginally after hours. Of course, we got earnings from one of the hottest stocks in the S&P 500. Really interesting movement in hims and hers, but I feel like you want to talk about Palantir.
Well, I just do, because I mean, the revenue growth was just phenomenal. For a company of this size that's gone so far, 63% overall on that top line to more than $1 billion. And the idea that you're now talking about a company that's getting more of a share out of the commercial side of the business, that was, of course, a big criticism when they went public, is that they were way too reliant on those government contracts.
Yeah, absolutely. Now the commercial business really in the spotlight. I did want to highlight Hims & Hers Health up 6% after hours. The third quarter results, the revenue beating estimates, but it was really this headline that got people excited, that Hims in talks with Novo to sell Wegovy shot and pill. You can see that is boosting that company, as well as Clorox also reporting earnings, and first quarter adjusted EPS beat estimates. This is The Close on Bloomberg. Well, China looking to buy U.S. wheat for the first time in a year following a trade truce between the two global superpowers. Following in the footsteps of the U.K., the first nation to lock in a trade agreement with the United States all the way back in May. The U.S. and U.K. now pushing for better AI collaboration through a tech prosperity deal, potentially positioning the two nations as a united front against China's threats on chips and on rare earths. Joining us now, I'm pleased to say, is Richard Hyde. He is General Counsel for the UK. Richard, great to have you with us. And I'd like to start there, actually. Is that a fair characterization that the US and the UK potentially aligning here as a united front against China in this arena?
Partly. I mean, the tech prosperity deal is broader than AI. AI is a really important element of it, but we also are looking at how do we collaborate together to develop quantum technologies, and how do we collaborate together to improve access to nuclear power across our two economies. So it's not specifically about China, but it is a recognition that we are in competition, and we think the UK and the US together are more competitive.
And it's interesting, and I have to imagine a delicate line to toe, any positioning as potentially being against China. And to that point, Richard, I have to ask, what are conversations between the UK and China sounding like, especially when you have these sort of alignments underway with the United States?
Well, I mean, I'm the British Consul General to the Midwest, so I'm not in the room for those conversations. But I imagine that the UK is a trading nation. We trade all around the world. We always have done. We're able to have conversations with different countries and different blocs at the same time. But we have to look at our own interests, and our interests are to align and to collaborate and to partner with our biggest trading partner and for us the most important partner we have in the world, which is the United States.
Well, I am curious. I mean, you're in Chicago today, and obviously the governor of Illinois has made a big to-do about the quantum computing initiatives, and obviously even prior to him taking office, we had already had a big presence in Illinois. I say we, as in that's my home state, but I'm not there now, in nuclear and some of the other ancillary tech areas. Why, though, are you sort of, I guess, working directly with the local governments on this rather than through the federal government?
Oh, we are. Trust me. We have we have an agreement with the state of Illinois. We have an agreement with the state of Colorado, and both of those agreements are very much centered around technology development, and at the center of all of that is quantum. Colorado and Illinois, as you say, both have federal quantum hubs. They both have huge amounts of political and state-level economic support to develop quantum, and we want to be part of that. So, as you'll know, Site Quantum, major investor in quantum technologies in Illinois. That's a company that evolved and emerged out of UK universities. So there's a strong collaboration at state level. But of course, we want to work with the federal government as well. We can walk and chew gum in the UK.
Thank you. We do too here. I am curious about the rest of your trip, though. I mean, you're going to a few other states, so this isn't just about Illinois and Chicago. We should just point out. I know you're scheduled to be in Indiana, specifically talking about this big move that we've seen by companies to move to more these small nuclear reactors to help power data centers and really everything else for that matter here. I am curious, though, as to exactly what the UK contributes to that. I know you're going specifically to a Rolls-Royce facility, obviously a UK company, but what exactly is the UK contributing to that effort?
So I'm based in Chicago, and I cover the 14 states across the Midwest. So I travel constantly around talking to governors, talking to mayors of large cities, talking to companies about how they can collaborate more effectively with the UK. The reality is that Rolls-Royce are one of a number of companies who are trying to perfect this small modular and advanced modular technology, which will will transform the way energy is delivered to a wide range of people in the UK and the US. So, of course, I'm very supportive of Rolls-Royce and what Rolls-Royce are trying to do, and they've been in Indiana for many, many years. So, obviously, speaking in Indiana with the governor of Indiana, with Purdue University, is all about kind of projecting that UK technological excellence in small modular reactors. But we are also seeing US companies in the same space looking at the UK as an investing destination to prove the deployability and the scalability of this technology. So our deal with the United States is about removing some of the regulatory burdens on both sides of the Atlantic to allow companies to move backwards and forwards and to progress this technology in the most efficient way possible. And it's not just about small modular reactors. It's also in the UK, it's about reinvesting again in the latest large nuclear systems. We didn't invest in nuclear for a number of years, and we now understand that it is one of the cleanest and most efficient forms of baseload power. So investing again in nuclear, and of course bringing our scientists together to look at the next generation of nuclear, which is fusion. So we're looking at collaborations around that as well. So it's forcing our scientists and our innovative companies and our energy demanding companies together to find these solutions collaboratively.
Well, Richard, I want to pivot from nuclear to agriculture specifically, obviously a hot topic of conversation. And I specifically want to talk about whiskey because that's one area where tariffs remain. And when it comes specifically to the whiskey tariffs, I mean, do you see that changing anytime soon?
I mean, whiskey is one of our major export products to the United States. And I cover the state of Kentucky, and it's one of the major export products of Kentucky into the United Kingdom. So we want to see tariffs removed wherever we can remove them, and whiskey is absolutely a priority for us. But it's, as you know, it's a complicated process. You know, the reason we've been able to achieve kind of first mover advantage on a trade deal with the United States under President Trump is that we are not a country that cheats in international trade. We have a balanced and fair trading relationship with the United States, and we just need to keep pushing, keep pressing to remove tariffs wherever we can, whether it be on whiskey, whether it be on steel, whatever the issue is, we're trying to remove that. But as part of this, a part of our trade deal, we opened up our market to American beef, American bison, and American ethanol. And these are important things for the administration, because trade deals shouldn't be about, they're not zero sum. We both have to gain from it. And we've been really clear that we want to make our market as accessible to the United States as we can. And in return, we want our products and our services to have access to the US. So whiskey is absolutely front of mind.
Richard, yeah, for me too. Richard, great to have you, and we got to get you back on here to talk about the progress and, more importantly, that partnership here with the United States. Richard Hyde there, the UK General Counsel for the U.S. Midwest here as we continue our coverage on Bloomberg Television and go even more local, hyper-local, a big election day tomorrow. 4 big races taking place, a gubernatorial race in New Jersey and in Virginia, a big prop ballot out there in California, and a consequential mayoral race here in New York City. Brad Lander, former mayoral candidate, going to be joining us after the break, and current New York City Comptroller. This is The Close on Bloomberg. New York City gearing up for a pivotal election day tomorrow. Zohran Mamdani and Andrew Cuomo facing off in the widely watched mayoral election. In addition to that, we have a closely watched gubernatorial race in New Jersey, as well as multiple critical seats up for grabs in Virginia, potentially a litmus test for the Democratic Party as they look to take back some modicum of power. Joining us right now is Brad Lander. He's New York City's comptroller and former mayoral candidate who actually cross-endorsed Mamdani during the primary election. Great to have you here, Brad.
Great to be here.
I'll get right to the brass tacks here. I mean, when we talk about some of the fears in this city about Mamdani, we've heard it from Wall Street, we've heard it from the real estate investors, we've heard it from the business community. Will he actually be good for this city's finances?
I think he's going to be great for the sense of the city having a diverse, creative energy and looking forward. Andrew Cuomo has run this sour, dark, backward-looking, everything is terrible campaign. I don't know why anyone would want to start a business in that city, but the hopeful one where things get more affordable, where people are still able to come here, I think they will. He's going to put a solid team together. I think business leaders will end up thinking, I don't remember what it was we were so worried about.
What's the balance, though, between sort of carrying out some of his policies to create affordable housing and free busing and other policies that effectively are going to cost money, and at the same time sort of at least support policies that are going to be conducive to people starting businesses, building buildings, et cetera?
Yeah, well, let's just use childcare as an example. So that's the place where Governor Hochul and Mayor Zohran are kind of best united. That's great for businesses. Yes, there has to be a little more money to pay for it. But if you see what you're getting is that your employees have a safe, high quality place for their 2- and 3-year-olds, that shows up in business productivity very quickly. It means your employees feel like they can afford to stay here instead of moving someplace else. You got to show you can deliver it, that it's cost effective, that it's worth the money being paid. But I think that's a win-win.
Well, you mentioned safety, and actually we sat down with Eugene Rem of Catch Hospitality Group last week. We asked him about the race. He said he really cares about safety at the end of the day. And to that point, Zohran Mamdani has said that he would keep Jessica Tisch to have her stay on as police commissioner if he is elected. Do you think that that's the right choice?
I do. I said during the primary, I was the first candidate to say I would ask Jessie Tisch to stay on board, and I'm delighted that Zohran has said it as well.
Let's game plan a little bit here. We were talking about potential outcomes in the break. So let's say that Zohran Mamdani wins, but only wins with a plurality, doesn't get more than 50% of the vote. What do you think that means for his agenda going forward?
Look, I do think after the race, by however much he wins, it's critical for New Yorkers to come back together. This race has been so full of vitriol. I mean, Andrew Cuomo's worst self is a very dark place, and we've been seeing more and more of it, and he's just stoked fear-mongering in a way that has people on edge. So what I hope is that the mayor-elect will bring people back together, say, hey, folks, whether you voted for me or didn't vote for me, I'm going to work hard to keep you safe. That vision of childcare is for you and your families. Let's heal some of the things that were broken. Donald Trump is coming for us, and we got to all respond together.
Also, to Katie's point, though, I mean, when we talk about Tish staying on as commissioner, there's been a lot of discussion about who Mamdani is going to put around him. There's, of course, one of the big knocks that Cuomo, at least, has tried to sort of levy his way is the idea that he doesn't have the experience to manage a city of this size and complexity here. Do you have any sense as to what that team is going to look like?
Well, look, I think people are going to get information on that pretty quickly. And what I'll say is...
Are you going to be on that team?
I think people will get information on that pretty quickly.
Okay.
I think a lot better. The people that are going to want to work for Zoran are energetic, are excited about it, have hope in the future of the city. No one wants to work for Andrew Cuomo. So this idea that it would be better to have him, I mean, he's an abusive boss, whereas Zoran is going to set the table in a way that says, hey, we get to write the next chapter. Focus on affordability, stand up to Trump. I think it's going to be a first-rate team.
Do you think the city, meaning the people in power in the city, are going to cooperate with him? The business leaders, the police unions, et cetera, et cetera?
Look, I mean, it's a city in which people got a lot of opinions and they feel strongly, but we love New York City. And that's a pretty profound feeling. So I really do hope even folks who don't vote for Zoran tomorrow will say, how can we work together to actually make it work? Everyone benefits from a more affordable, from a safer, from a more inclusive city.
Well, Brad, let's try to get at your future plans through a different way. Are you planning to run for Congress in the 10th district? Or are you waiting to see how tomorrow shakes out?
For today, I'm really focused on helping Zoran win tomorrow, on making sure these affordable housing ballot propositions pass tomorrow, which people aren't talking about, but are a big deal for building more housing. So through tomorrow when the polls close, I'm going to stay focused on helping make sure those things happen.
Well, with that in mind, talk us through what the next 24+ hours look like for you, because I have to imagine this is a sprint to the finish.
Oh, we started today at 6 a.m. with Zoran and a crew of us walking across the Brooklyn Bridge. Polls open at 6 a.m. tomorrow. They go till 9 p.m. It's really important that everyone comes out to vote. Most people don't even know about those pro-housing ballot propositions. So I'll be out at poll sites saying, hey, here's an opportunity for you to vote for more affordable housing to get built. We'll bring it home all the way till they close at 9 p.m. and then we'll get to be together and celebrate the results.
I'm going to ask you a very loaded question here, Brad, and this has to do with your campaign and why it didn't succeed. There's been a lot of talk about this sort of being a litmus test for progressivism or whatever the Democratic Party is trying to be here. Why did Zoran bubble up? Out of nowhere for a lot of people. People like you didn't. Cuomo's behind in the polls, and Adams is out of the race.
Yeah, look, well, I mean, Adams sold our city out first to Turkey and then to Trump, and people are tired of corruption. Cuomo came in with big leadership and name recognition, but ran a sour, backward-looking race. I ran the campaign, maybe you could say, of the guy that does the homework. And that wasn't what voters were excited by. Zoran ran a campaign that inspired and excited people, that focused on affordability, that offers something new and hopeful in a dark time.
All right, Brad, got to leave it there. Great to get some time with you. That is Brad Lander, New York City Comptroller. You can watch a special edition of Balance of Power tomorrow, starting at 5 p.m. Eastern.